Good morning and welcome everyone to the Moneycontrol live stream. You're watching the opening bell and I'm your host Nickey Mirchandani. Well, Indian equity markets set to end the week. Looks like it's going to be a weekend to the markets. Global cues at this point of time are suggesting of a negative start coming in for Indian equity markets. GIFT Nifty is hinting at further pressure coming in for Indian equities. US stocks overnight slide and 10-year US Treasury yields reached to a 16-year high level. US Federal Reserve Chairman said additional interest rate hikes could be warranted. That perhaps is weighing down on the sentiment globally. Asian stocks also fall. Oil advances on Middle East tension. Talk about the commentaries. Traders wait Federal Reserve Chairman's remark for any more cues on the policy outlook. Talk about FII data. They've been sellers. Sold shares worth around 1,093 crore and DIIs have purchased equity to an extent of 736 odd crore. What we have in terms of FII in the whole FNOQ space, well, FIIs have been the net sellers in index futures, but they have been the buyers in index options and stock futures. Also the buyers in Bank Nifty futures and have been the sellers in Bank Nifty options. Put together, they have been sellers essentially in the Bank Nifty option along with that of index futures. So that's a bit of takeaway from the cues out there. But let's also talk about the ban, FNO ban, right? What still remains in ban is Delta Corp, Balrampur Chini, India Cement, Manappuram Finance, India Bull Housing Finance, GNFC, MCX. What comes out of the ban is SAIL, Hindustan Copper. Now, also let's talk about the option cues. Nifty PCR is right now at 1, indicating the market is fairly balanced and no perhaps overselling. It's a decent entry point at 0. This compares to 0.82 in the previous session. Earnings that need to be watched out for. JSW Steel is amongst clearly one of the numbers that you need to keep an eye out on. Apart from that, we also have slew of numbers. 197 Communication, L&T Finance Holding, Poonawalla FinCorp. We have Atul, Butterfly, along with that, something in the life fall also, Century Textile, CG Power and Industrials, along with Hindustan Zinc, ICRA, Jammu Kashmir Bank, Just Dial. These are some of the companies that you need to keep an eye out on. Clearly, let's discuss the trade setup, strategies for the day, along with few stock recommendations with Aamar Singh, the Senior Vice President at AngelOne. Morning there.
Yeah, thank you, Nickey.
All right, Aamar, let's start off with your assessment of how the trade setup is looking like. Do you expect further pressure? What is the key support level for the markets at this point?
I would say that over the last few trading sessions, we've witnessed more or less choppy trading sessions. And if you look at the charts, the medium-term, intermediate, as well as the short-term charts, clearly they show that there's more of consolidation that's happening. But the good thing is that on the downside, Nifty seems to be strongly supported around the 19,300 zone. So that's very crucial. So 19,200, 19,300, that's a major zone of support. On the upside, however, what we are seeing is the moment Nifty tries to sustain above the 19,800 levels. So 19,800, 900, that's a zone of, again, resistance coming in. So effectively, and if you look at the global cues as well as the data also, the data flow in terms of the geopolitical tensions, in terms of crude oil prices, in terms of the recent US Fed chairman speak. So clearly shows that there are concerns in the market and investors are also looking at that. But having said that, we still see a lot of upside. We've seen some significant rally across the board, across, I would say, majorly in the mid cap and the small cap stocks still that has been there, and the breadth has been positive. And the other interesting thing is that in spite of all this, we've seen the India VIX still remaining very on the below the 12 mark. So that also clearly shows that investors are worried, but they are not that duly worried. And as far as the benchmark indices concerned, Nifty, Bank Nifty, we see that there would be, again, it's more of consolidation, selling at higher levels as well as buying at lower levels. So these are the ranges that one needs to look at. And talking about the OI data, what we see is that there's been long unwinding happening in Nifty over the last couple of days. And earlier also we saw that short build-up was happening. So this exception was in the last 6 trading sessions, there was one day when we had long build-up. Otherwise, it's more or less clearly showing that investors are somewhat concerned with this regard. And at least in the major heavyweights, there's some sort of wait and watch approach.
Sure, we're going to be addressing in the market open in just a jiffy, but we're going to come back to you, Aamar, and check with you what do you make out of something like an ITC and HUL. Of course, Nifty 50 at this point of time, 19,600 mark, way below that level. That's been taken off. 19,500 mark now is acting as a stiff support level coming for the markets. Further pressure, selling pressure, it's just accentuated for the markets in sync with the globe. 0.5% of losses clocked in for the Nifty 50 index overall. Let's talk about Bank Nifty. How is that stacking up? Just to see how's the momentum going across the globe right now, and also for the Indian equity markets. 0.3% of losses coming in for Bank Nifty, and we are witnessing some amount of selling pressure also creeping into Bank Nifty at this point of time. Mid-cap index seems to be also adding to perhaps, or it's just surrendered in some kind of selling pressure, but small cap index, that's a bit of dichotomy in trend there. It continues, or rather just say continuity of outperformance there. 0.2% of gains coming in for the mid cap index. Let's also talk about what we have in terms of the sectoral indices, the IT, the auto, FMCG pack essentially. Auto is right now there on the screen, down and out with losses to an extent. Let's just say just marginal losses of 0.2%. Nifty metal flat start with negative bias. And also let's talk about IT, FMCG, and then talk about ITC for that matter. Nifty IT right now, it is a flat start with negative bias for Nifty IT index. And if you pull up further, which is FMCG basket, it is also surrendered to some amount of selling pressure. It is down and out with losses of more than, or let's just say it's lower with losses of around 0.75% thereabouts. Let's also talk about ITC and HUL, how they've stacked up in the trade before we go on to our top gainers and the top losers. ITC, some amount of selling pressure in early deals, and let's also talk about HUL in that case. HUL remains to be seen. How is that stacking up on the back of earnings? But also let's look at the top gainers and the top losers that we have on the list. Well, HUL also has surrendered to some amount of selling pressure. Now, the top gainers out there, Adani Enterprises, Ultratech Cement and Tata Motors. These are some of the top gainers that we have on back of the earnings and upgrades that have come in for Ultratech Cement. That stock is doing well. Adani Ports, ONGC and IndusInd Bank. These are some of the other top gainers that we have. Let's also look at the top losers just to see how is the trend stacking up there. HUL perhaps is the top loser of the day. DV's Lab, Asian Paints, these are some of the other losers along with Power Grid, Cipla and HCL Technologies. So clearly some amount of selling pressure accentuating for these companies. But let's actually go across to our guest, Aamar, and check with him what does he make out of something like an HUL and ITC. HUL is clearly one of the top losers of the day. What's the strategy there? He thinks, does it serve as a good entry point here on?
Yeah, I would say that if you look at HUL is one of the stock which over the last, I would say, many months, it's not been going anywhere, and it's clearly witnessing consolidation, because what we are seeing in the stock is that the stock has got very strong resistance. A lot of selling pressure comes, or a lot of selling interest comes around the 2,700 mark or so, and the stock has been trying to sustain above that level, but that's not happening. Also, if you look at the long-term charts, be the monthly, quarterly charts, they clearly show that the uptrend or the bullish momentum which was there, then now that's no more there. So what it effectively means is that any pullback in the stock will be used as a profit booking opportunity for those who enter the stock. However, what we are seeing is on the downside, the stock seems to be very strongly supported around the 2,400 mark, because that's the level from where the stock has been bouncing back. But I wouldn't read much into the stock in terms of trend, because the long-term as well as the intermediate-term trend clearly tells me that it's a very good consolidation play between 2,400 on the downside and 2,700 on the upside. Talking about the other stock which you mentioned, ITC. ITC has got a completely different structure vis-a-vis HUL. ITC is extremely strong on the long-term charts. Yeah, short-term we've seen some sort of correction from almost 500 levels currently. So it's down. So on the downside, the stock has got good support coming around the 420, 430 zone. So roughly around the 400, 420 zone, that's a zone of support. So any correction in the stock can be used as a buying opportunity. However, what we are seeing is that on the weekly charts, one of the technical indicators, they clearly show that it's very negative on the weekly chart. So what it effectively means is that any pullback in the stock will be met with some sort of profit booking in the stock. But overall, ITC is in a better position vis-a-vis HUL on the long-term charts.
Aamar, thank you so much for taking out the time and speaking to us this morning. We're just going to leave it at that. Let's also address an HUL numbers in ITC before we go on to the key guest of the show. HUL, good operational performance, sharp gross margin expansion, EBITDA beat despite higher ad spends. That's perhaps the long and short of HUL. ITC, well, good set of numbers again. Cigarette revenues is up by 10%. EBIT is coming at 8%. The volumes are around that 6-7%, which is essentially, they were estimated around that 5 to 6 odd percent. FMCG revenue is on the higher base. Hotel revenue is up by 21%. EBIT is almost shot up by 50%. So overall for ITC, it is something which seems like some amount of miss which came in due to paper boats, but that should only get better ahead. Most of the brokerages call the cigarette volume, which is perhaps one of the reasons for outperformance, saying that this number is also the volume growth number of the cigarette business has moderated to a multi-quarter low. But overall, it is an impressive show given how the other FMCG players have performed thus far. United Breweries too, there's a mixed bag. And the numbers, the revenues above estimates, margins have been missed, and the volume growth is in line with estimates. Zomato, that's the last one for you. SoftBank, SVF, Growth Singapore is selling 1% of stake for, via block deal. This is happening at some amount of flatness or discount out there, so to keep an eye out on this one as well. The offer price range is 109 to 111 per share, so roughly they're about the current market level. There's a downgrade which is coming on IGL by Jefferies. The stock already tanked in 5% in previous session of trade on account of the adoption of the Delhi government policy. Delhi government submitted a policy on EV adoption. That perhaps is weighing down on the counter, but that's the long and short of what we have in terms of the brokerage calls and the stocks. But let's discuss now. It is a Friday special, and we have a key guest who's going to be talking about the impact of Israel-Hamas conflict, oil on the Indian equity markets, about the low float of stocks perhaps, and all of that, even the FII trend and what kind of bearing, how large caps have been doing well, not doing well as compared to the broader counterparts. But without any further ado, let's get in. Prateek Agarwal, the Executive Director of Motilal Oswal AMC. Morning there.
Good morning.
All right, I'm going to start off by directly first. Thank you so much for joining us and taking out the time to have a conversation here. But I'm going to start off by asking you about your assessment of why, overall, how do you see the markets right now, given the kind of geopolitical risk that we're sitting at, given the kind of some amount of selling pressure that is coming in from FIIs, why the large caps aren't really doing well? And do you think the outperformance of perhaps broader counterparts will continue here on?
Yeah, let me construct it like this. Outperformance lies in a part where earnings growth is higher. Now, from the bottom of COVID lows, if you see, the mids and the smalls have done substantially higher earnings CAGR versus the large, in part because of very strong and supportive government policies. And I think till the support continues, this space could continue to outperform. Even now, if you see, most brokerages, for example, would put out a number for the Nifty kind of an index and would put out a number in terms of growth for their coverage, which is the broader market. And typically, the coverage would have a higher growth versus the Nifty itself, which points to more buoyancy of the larger caps. Bond yields are high in the West. US bond yields are crossing 5% on 10 years. Now, with that kind of bond yields, one should not be expecting FPIs to put in money overall into emerging market. We should be expecting investors there to be moving to debt rather than to equity. What India has seen is a benefit of, to some extent, substitution effect. Maybe people have taken out monies from other EMs and put into India, but I think it is far reason to expect FPIs to continue to be sellers rather than buyers. they own more of the larger caps, and that is a part which should then be expected to see continuous amount of selling pressure. The thing is just the opposite on the mid and the small cap part of the market, where after a long while we have some structural inflows. So if you see domestic Indian money, it is structural, it is coming in on the trot. We are seeing what has happened in China between 2008 and now, beginning to be seen in the country over the last 2 years. And happily now SIPs are a larger part of total, and half of that money comes into mid and the small cap funds, which is providing this space a lot of strength, because otherwise it was just the top 100 companies which were getting money. Now mids are the next 150, smalls are everything else. They have started to get some flows, and yes, the start point of all of this is better earnings growth. Better flows, and then better ability to raise monies for growth. So it becomes a virtuous cycle. We hope it continues. Key thing there is supportive government policies. Now, your next one, which was geopolitics, Israel, etc. So, frankly speaking, war is never good, but I should not say this, but war is good business for people who are not indulging into it. Happily, our country is not trying to benefit for it, so we have a high moral ground. The risk that is there. So on oil, let me just make one simple statement. That's the biggest risk. The war is going on around the areas where which are oil producing, and that is the sensitivity. Now, oil production and demand are very well balanced. In fact, oil production had to be cut to sustain prices at 85. Now, in some manner, the way to look at the market is that we are building in a $5 premium for risk. Hopefully, as things settle down and people understand that this will not flare up, we could see a fall in the oil prices to 80, 85 kind of a level. That said, if you look at Indian exports, imports, trade data, the sense is if you extrapolate last month trade data, we could end at 1.1, 1.2 current account deficit, which would still mean because of capital inflows, the country gets $20 billion of excess dollars into the country, and the reserves go up. So, in terms of sustainability, a brief spike to 100, even over 100 could be sustainable. And my sense is, hence, we should not expect the growth impetus that the economy has from the government, from the policymakers to be dampened below 100. I think till then, the government would allow the economy to grow on the trot. After that, maybe we will see some measures to slow it down. Till the economy grows the way it has been, I think it continues to be time for alpha.
Sure. Prateek, I also want to understand, as an AMC, now amidst Middle East tension and the oil boiling to the level that it is, and perhaps you citing that as the biggest risk to the equity markets and India economy put together, what kind of theme are you focusing on?
So we are high quality, high growth investors, and try and chisel out very narrow spaces in the market which can offer longevity of growth and a quantum of growth which is seriously higher than that of the index itself. So spaces like new tech is something that we like. Spaces like hospitals in the healthcare space, mid-cap IT services which are not headwinded because of the BFSI slowdown, let's say, or issues in the West. Let's say in financials, we want the retail focused banks where AUM growth could be stronger, because it's AUM growth which will result in profit growth as we go forward. The base effect and the lower NPA effect is wearing out. Defense, engineering, where the longevity of growth seemingly is quite long, given the Make in India thrust and the focus to increase manufacturing as a part of the GDP. So, and yes, China Plus One is a large theme through EMS companies and maybe through chemical companies. Some bit of this is definitely experiencing a bit of headwinds just now. So our portfolios today tend to be more inward looking, more domestic focused than external focus. So we are underweighted IT, we are underweighted, typically speaking, export oriented businesses, more domestic focus. So that is how it is.
Sure. Prateek, I just want to understand one thing. As an AMC, is this a conscious strategy to stay away from anything which is related to crude-related strategies or the derivatives thereof? Are you just going to be avoiding that entire basket that you can look at? It could be the oil marketing companies, it could be paints for that matter, the defense space, even given the kind of geopolitical concerns, reasons around that. What is your perspective around the three categories?
No, so defense, we are invested. We think it is a very long period theme. It is having a lot of tailwinds. I think the thing which caught the eye and has been amazing, me in particular, is the government putting out list after list of items which they will not import. It has to be made in the country. Never been done before, and this just takes away any uncertainty. In a democracy, you put out a list in the public domain saying this will be made in the country is a huge statement. So I think it is a very long period theme. If we substitute more and more of the imports as we go forward, I think it gives you a visibility that other spaces may not offer. Coming down to your next space, oil, there is no way to hedge oil prices in the country. Our oil, upstream oil companies and oil refining and marketing companies, in the manner in which, in the order in which they function, almost target one kind of profits, maybe related to volumes. But not margins, so government comes in and puts in a tax or the other. So upstream would get 70, 75, around $75 pricing, not over that. And refining and marketing also something or the other to the effect keeps happening. In one period they make more money, in the next period they make less. Now, in some manner, targeting amount of money they will make in a year, and in between acting as a cushion to paper out volatility of prices. Now, alternate energy providers like coal, once again, the auction volumes, are not going up. It is more of the linkage coal. It is more of the coal which is sold at almost predetermined prices. That is where the volumes are going up, and which means the profit increases would be more in line with production growth. So it becomes very, very difficult to hedge against oil prices in a country like ours, which is such a large importer of energy. Now, that said, something very interesting is happening just now. We are importing 40-45% of our oil from cheaper sources in the Middle East and Russia, and that I think gives a benefit of between $5 and $10 billion to the country in a year, distributed between the government as higher taxes, oil companies as maybe higher margins, and manufacturing once again as higher margins in some manner. Which is seen. So I think as such, very little manner of protecting against higher oil. But I think if you get cheaper input versus your global competition, then manufacturing is one way to protect against this, because they get an edge versus other global players.
The last question that I have for you is, what's your view overall on those low free, the free float stocks, which perhaps have got into a discussion mode where the low float stocks have been gaining traction? There could be in the likes of PSU metals, public sector banks, and even some private spaces. Would you want to talk more about that? How are you looking at it?
So, now let me say this. Today, we see the government working harder than the private sector. Okay, and you speak to many of the private sector chieftains, they would happily acknowledge that. And we do believe it is working to a plan. I can say this, I have relatives in the government who are working harder than I am. Okay, so why should, economy is doing well, why should PSUs, who are still having a very large part of the economy, not participate well? To start with, they were cheaper. A lot of their issues got sorted out. So, I think the long period themes are correct. That over a long period of time, private sector does better because they sustain whatever pace they are doing. PSUs, after a very long while, are showing what they are showing. That said, yes, in the marketplace, always it happens when markets are buoyant. People try out various things. And one thing is very clearly, spaces where liquidity is less, get cornered and move up sharply. Happily, if you see the portfolios of institutions, you will hardly find those kind of names. So it is very, very retailish kind of activity. I think the private sector entities may take advantage of it quicker by selling some stock and making use of this spike to raise money. Government there takes a slightly longer time, but one should expect the government to also do the same over a period of time.
All right, Prateek, we are going to leave it at that. And thank you for taking out the time and speaking to us this morning.
Thank you.
All right, with this, it's a wrap, and goodbye from the entire team who puts this piece together. Thank you so much for watching. Please do post your feedback for us in the comment section below. Follow us at the link at the bottom of your screen. And for the rest of the page, stay tuned into moneycontrol.com and Moneycontrol app.